Do what works for you, but just think about it. When we talk about money and we talk about, is that in your budget? Just ask yourself, is renting in your budget? No, for real, is renting in your budget? Do you want to be a serial renter all your life? You don't ever want to own nothing? You just like liabilities. That's what you like? Are you scared? Welcome to Mi Casa. See? Y'all could be talking about that. Think about all the parties and everything that y'all can be doing, hosting for your holidays and so much more. But go ahead, let's get to it. If you decide to become a homeowner, let me go ahead and break it down to you on how to become a homeowner. Let's go. Welcome to your success stories. I am your girl Nika Johnson, a credit coach and budgeting expert, and today I'm gonna help you get there. We're gonna be talking about homeownership. That's right, how to become a homeowner. Simply put, you either go pay somebody else's mortgage or you go pay your own. I am tired of seeing the countless debates on social media that a house is not an asset. I'm tired of seeing people saying that buying a home is a poor choice. If you do the math, just sit here and think about it. Let's say that you are renting and your monthly rent is $1,200. That's times 12. That means you're spending $14,400. Now let's take it a step further. Let's say that you are renting for 5 years with that same amount. That means you just spent $72,000 in rent. At the end of the day, you either go pay somebody else's mortgage or you go pay your own. But the choice is yours. People often always saying that buying a house is not an asset, it's a liability. It's the bank's, it's not really yours. But I just got a question for you. Can you borrow from renting? No. Can you use the equity from renting? No. Can you claim it on your taxes? No. Can you pass that down to your kids? So I'm just confused on the tireless debate of social media saying that buying a house is still a liability. No, it's not. There's so many different tax write-offs. Let's go ahead and get into it. There are 3 factors that impacts you of becoming a homeowner. That's credit, income, and your DTI. And DTI essentially is your debt to income ratio. So let's talk about your credit. I'm sorry, if you got piss poor credit, how do you think you're about to become a homeowner? Now, technically, could you buy a house with a 550 credit score? Absolutely. However, you're gonna be going through hoops and hurdles, and it's going to be more discouraging of not wanting to continue the process versus you're just waiting a little bit more. One thing is I always say is that you don't want to outgrow your home. You don't want to become house poor. And if you took the time to actually fix your credit, you could be able to get a better deal by saving money on interest, by the approval threshold, like the dollar amount that they're going to approve you of. Is it $200,000, $300,000, $500,000, or $1 million, whatever that case may be. So sometimes it's better to make the necessary sacrifice, fix your credit in 6 to 9 months, sometimes sooner, depending what's in your credit profile, and then go back to the drawing board to go get a approval to have more of that buying power, right? Because essentially where you're falling at that credit score, that's going to impact your interest rate. That impacts your monthly payment amount. That impacts how much interest you picking up what I'm putting down. I'm just saying. Your credit is going to be so important. So when you're purchasing a home, they do something called a tri-merge credit profile. That is using Experian, Equifax, and TransUnion. They're going to combine the 3, okay? What they're going to do is drop the highest and they're going to drop the lowest, and that middle score is what's going to be assigned to your interest rate. Now here's the alternative into that. Let's say that you are doing joint applicant. So let's say that you are doing husband and wife. One party has a high credit score and one person has poor credit. One or two things is going to happen. You don't want your applicant, your partner, your spouse on that application raising bids because they're going to drop that score. Because with the joint applicant of 2 people on a loan application of purchasing a home, they're going to take the middle score of the lowest, okay? So let's do an example here. So let's say that spouse number 1 has a credit score of 700, 710, 730, right? What they're gonna do is drop the highest, drop the lowest is the middle number, right? So then let's say spouse 2 have a credit score of 490, 500, 510. They're gonna take that middle number of the 2. That's what that interest rate is gonna be assigned. So you wanna be cautious of what works best for you. So should you add the applicant on because it's more income, or does it do more more harm than good. So sometimes that's why spouses buy a house off of one income. And I always recommend that because you don't want to be house poor. Like, let's keep it real. Nobody really talks about that. Yeah, you can have a lot of overtime commission and bonuses, and you may always work that, but doesn't mean that it's always guaranteed. So if you get hurt on the job, you're only gonna get paid 60% of your work, like your work base. So you wouldn't really be bringing in that extra money that you're used to because of that overtime, right? So that's one perspective. Another thing is that what happens is people become house poor because you're purchasing a house off of two incomes instead of just doing one. Because what happens if someone lost their job? What about if someone died? Because you still maintain that same lifestyle. So just from a financial standpoint, I'm gonna be honest, I always recommend, just because you have two incomes, purchase a house off of one. You can be able to build, invest, and just leverage so much more that way. So that's what I mean by not being house poor. Okay, we got that. But another thing, like when it comes down to credit, is why is that so important? Because it's your risk. It's your ability to promise to repay. That tells the bank if they give you this loan for X amount of dollars, then you pay that back. This is why your credit score is so important. So you want to be careful of, hold on. Now, if you like it and enjoy this video, make sure you like it, comment, and subscribe, and show your girl some love, and turn on that post notification because we got so much more. Stay tuned because we dropping videos week after week, and let's get it, okay? Now, when it comes to buying a house with a lower credit score, it is such a headache. I guess that's the easiest way that I can put it. As being a previous loan officer doing second mortgages in the state of Nebraska, just having clients that was trying to go through the process, it is literally hell and chaotic. So with the economy and the pandemic, a lot of financial institutions, they want to see typically the average credit score. Do you know? Let me know before I tell y'all. What do you think is the average credit score that the bank would like to see? Is it A? Is it B? Or C? Or D? Answer is C. The average credit score that they like to see of purchasing a home is going to be a 640 FICO. Now, this is another thing. Make for sure you understand when we're talking about credit, you can't go apply for an application and thinking like, oh my gosh, I got a 720 on Credit Karma. Baby, that is a fancy score. That is not your FICO. And there's something called different weights. So they're going to heavily weight when you're purchasing a home, when they're doing that tri-merge credit report. So you want your FICO score, not your Vantage score. And I only really recommend paying for credit monitoring if it's within 3 months out. You don't necessarily need to really pay for credit monitoring unless you're actually in credit repair and trying to fix your credit. Those are times when a Vantage score is acceptable. But other than that, don't waste your money. Go ahead and go to Experian.com and get your FICO score for free. It reports and updates once a month. But if you need more detailed help, click down below and go ahead and purchase How to Buy a House, How to Become That Homeowner, Making That Dream a Reality. Go ahead and snag the ebook down below, made with you in mind. But essentially, when it comes to credit, it's that risk, honestly. It's the risk of the ability to promise to repay. That credit is going to show that. So the higher your credit score, the better. So yes, they like to see a 640 FICO score. Now, the little higher, the little more buying power. I like to see my clients at least at a 700. So this is why it's important when you're looking at your credit report and you have certain merchants account that is only reporting on one bureau. This is why you'll see a fluctuate difference of your score sometimes. Make for sure that you have accounts that's reporting to all three credit bureaus: Experian, Equifax, and TransUnion, okay? While I'm at it, let me go ahead and just plug this in while we're talking about credit. You can buy a house after bankruptcy, okay? You don't have to wait 7 years. You don't have to wait 10 years. Sometimes they do want to see within that 2-year time frame since, filing that bankruptcy. You can live life outside of bankruptcy, and you don't always need to dispute your bankruptcies to buy a house or anything of that nature. Is because there's something called secondary credit bureaus. The secondary credit bureaus are example like this, and like that. You may see your bankruptcy removed off of one or two or all three of the main bureaus, but then when you're applying and going through the process of buying a house, then it still comes up. That's because it's on the secondary bureaus. So double check LexisNexis. But if you need more help as far as with your credit, check out our DIY credit ebook, Made with You in Mind, or go ahead and sign up for our credit report services at www.budget2success.net. We real and reliable, and we ain't no scamming out here hustling, okay? All right, so when we're talking about credit, we know the bare minimum is a 640, but the higher credit score, the better. Another tidbit is, you know, when we're looking at a credit, I have another YouTube video talking about ways of how to fix your credit. Check that out. So it goes into details of what are some things that you can do to be able to fix your credit and just to make for sure that your credit readiness. So we talked about there's 3 things of becoming a homeowner, and we done touched number 1, which is your credit. Again, what is your credit score? Your adult GPA. It's a reflection of your buying power. It will tell you if you're approved or denied for a loan, if you need a cosign or not, or what's the interest rate. Simply put, bad credit is expensive, baby. It don't have to be a life sentence. You ain't the first person to have bad credit, and you won't be the last. So quit feeling embarrassed about it, because sometimes you may need to experience having bad credit so you can appreciate it when you have good credit. But quit drowning in sorrow. Quit thinking people gonna feel sorry for you. Do what you need to do and fix your credit, and quit allowing it to hold you back. Don't sit up here saying that you want to become a homeowner, but you're not changing your daily habits to make that happen. We got a YouTube video about daily habits. But the reality is, you can't sit up here and say that you want to become a homeowner and your credit's bad. Are you fixing it yourself? Did you hire a company like Budget to Success? What are you doing to repair your credit so it can be credit worthiness? And another thing is, like, quit thinking that even when you're renting a house, I know this is about homeownership, but even when you're renting a house, quit being mad at everybody else, a landlord or a company denying you, because at the end of the day, you are at risk. Change that. So just because something happened to you 3-5 years ago, you don't still want to be judged for that. And this is why your credit is so important. Your credit is everything that you can imagine. Become a homeowner. Make your dream a reality. Leave something to your kids. Have parties, you know, hosting and creating memories. You know, it's something that is yours. And if you go pay a monthly fee, you might as well get a house. Now, maybe home ownership is not for you, but you could still invest. You could still be a landlord. You could still be able to do it in different ways. You could buy a condo, but do what works for you. But just think about it. When we talk about money and we talk about, is that in your budget? Just ask yourself, is renting in your budget? No, for real. Is renting in your budget? Do you want to be a serial renter all your life? You don't ever want to own nothing? You just like liabilities. That's what you like? Are you scared? I don't know, but only you know. I ain't gonna stress about it. But you got the information. Now it's up to you to do something about it. Next thing that impacts your credit, boom, 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 is your income. Quit switching job to job. Now, a couple things. You can be a college student, and as soon as you graduate college, you can get approved for a home. Do not put all your eggs in one basket. Because one company denied you don't mean that you can't go get another quote. I always recommend 3 quotes. You want to get 3 quotes, pre-approvals, in regards to becoming a homeowner. When you're going through this process, so go through a bank, go through a credit union, or go through another company. I go through this more in depth in our homeownership ebook, so make sure you go snag that. And this is what the ebook look like. So go ahead and go visit isthatInYourBudget.com. Go ahead and grab the things you need to help you on to find the level of success that you desire through budgeting, savings, and credit. But while we're talking about it, make sure you like it, comment, and subscribe, and turn on your post notifications, and show your girl some love. But when we're talking about income, is you can be able to purchase a home right out of college. What they can do is use your education, your transcript, in lieu of that history. You also could be able to, if you're getting a job, starting your career right after college, you could be able to get that on a letterhead, and the bank could use that as a source of verified funds to verify that income, okay? What that is POI, proof of income. That's what they want to verify. Now, if you're not in college, let's say that you're just in the process of purchasing a home, they typically like to see that you're at your last job for 2 years. Now, if you leave sooner than that, if you only been there for a year, that is okay. They don't like to see gaps in your employment history. Also, another thing is, let's say that you just started a new job a month ago, 2 months ago, but it's in the same industry, that helps as well. But be careful on what you're telling them. So let's say, for example, that you have a client and you work on demand and things like that. Be careful on the word, is because if you say anything that's a red flag, the loan officer is responsible for putting that in that application to see if you're approved or denied. So make for sure that you are not telling them certain things that could be a risk or a red flag. Now, depending on the financial institution, you can pick up a part-time job, and that part-time job can be used as income as well. But typically, they're going to verify your last paycheck stubs and your last 2 years of tax returns. Now, if you are a daycare owner, I see this a lot for those that are a daycare owner. Typically, they're writing everything off on their taxes. Guess what? Now it looks like you ain't making no money, baby. Real bosses pay taxes. Quit worrying about what everybody else telling you to write everything off your taxes, because that's why you can't get approved for nothing, because your DTI looks too high. And talking about your income, let's go ahead and get into DTI, which is the third thing that impacts you becoming a homeowner. Your debt to income ratio. So how well can you pay off your debt? How much expenses do you have? Are you managing that? Quit always doing the income driven repayment plan, the IDR for your student loans, and pay them. They are going to calculate how much is your monthly payments to your student loan. There's so many factors that goes into it, but you want to make sure that you're paying off your credit card balances. Boom. Pay off your credit card balances, that give you more buying power. What I mean by that is, let's say that you was approved for a $200,000 house, but you have $10,000, $20,000, $50,000 on credit cards, right? But if you pay that down, that's going to reduce your DTI, your debt to income ratio, which increase that approval letter threshold amount. So instead of $200,000, maybe you could get approved for $250,000. So I always recommend paying off your debt as much as possible, especially pay off them credit cards and don't use them until you close. So make for sure that you are paying off your debt to just have more buying power. And typically the threshold is a 45% DTI, or sometimes they could go up to 50% depending on the financial institution. And the reason why I always say rate shop is because a credit union may give you an interest rate of 5% and only approve you for $180,000. But what about if somebody else gave you an interest rate of 6% and approve you for $200 or $210? You see what I'm saying? So always rate shop. Don't be loyal to a bank that's not loyal to you. Meaning just because you had this account at this financial institution since you was 10 years old and your mama, your grandma, and all your family go there, don't mean you got to do all your business there. Yes, it may be convenient, but you can still set up auto pay in different aspects. Just go what works for you. So what is the best deal you're going to get? How much money are they approving you? And then also, what is that interest rate? Because it comes down to that. Now, could you buy a house and go refinance at a later time and get a better interest rate? Absolutely. So those are the 3 things that impacts purchasing a home. Now let's go ahead and get into it of some of the different things that you want to be aware of when purchasing a home. I like to recommend getting that pre-approval first. So the difference between pre-qualified, pre-approval. Pre-qualify is when you are going online, boom, 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 boom. You enter your information, and based off the income and all the details that you provided, they're gonna say, congratulations, you are pre-approved for X and Y and Z amount, okay? Pre-approval is when they actually are pulling your credit, so that is a hard inquiry, into where you are providing your income information and they're verifying the income. That is a pre-approval. So I recommend for you to get a pre-approval before getting a realtor, because if you're getting hired, certain thresholds houses, some people won't allow you to go look at a house unless they know for sure that you pre-approved. Another aspect is that it's a waste of time. I'm sorry. I'm not a realtor. I know a lot of them, but it's a waste of time to go be looking at houses that at a certain price point and you not even qualified for it. Make it make sense. So I would recommend getting your pre-approval. So, work with a loan officer. But before you work in a loan officer, let's go back. You're going to rate shop. You're going to submit that into 3 different financial institutions. You're going to get that pre-approval, then get that realtor, and then start searching for a house. But while you are in the process of becoming a homeowner, don't be afraid. On Sunday fun days, make that a day for the family to go look at houses. This is how you dream big. This is how you manifest the life that you want. I went from a 1,400 square foot house to 3,500 plus square foot house, so to me is that the power of manifestation, to be able to go to those open houses, was able to allow me to really dream big, okay? Y'all know the phrase, dream, okay? The representation of knowing that we can do it, the representation of knowing that it's beyond just on movies and what you see on social media, that you can be able to dream and to be able to have nice things, to live in a community that's gated, to have a clubhouse, to have water softener, brand new washer and dryer, to have a pool in your backyard. Like, these are all things that you can have, but I want you to make for sure that you are intentional with your goals, be intentional with your finances, and get that doubt and that fear out of your mind, okay? Remember, whatever you put your mind to, you can do it. But take the time and go to open houses. Go see what type of floor plans you like. Is it a ranch? Is it a 2-story? Is it a community with HOA? But more of this goes in depth, so make for sure you snap How to Become a Homeowner ebook so it could truly help you. Those are just some tips and tricks that I can truly provide to you throughout this process. Next steps, some of the different steps, a part of the process of becoming a homeowner is, now that you are pre-approved, you got that realtor, now you're looking at your houses, make for sure that it's someone that is quality, that's good, got some skin in the game, or have a solid team that could be able to support them in writing those offer letters, so you could be able to get the house of your dreams, so you can get the keys. But you want to make for sure that in that process get an inspection, okay? Always get an inspection. Appraisal and inspection is completely different, but inspection is really going to tell you what is the ins and outs of the home. This is going to allow you to go back to the table to be able to negotiate and say, hey, I want this towards closing costs. I want to renegotiate the actual purchase price, or these are things that I want fixed up, or you want some type of credit, but this is a dollar amount that you can't put no peace of mind on it. So I use this mom and pop guy, that's here locally, been using him for years, and I think roughly an estimate for inspections about $550. So I definitely would do it if you're serious about the house that you decide and put in that offer and if it's accepted. But ultimately is that becoming a homeowner is a process, but it's worthwhile. There are so many benefits of becoming a homeowner, and it's such a rewarding thing to have something of your own. Like we talked about earlier, how much money do you want to invest into somebody else's mortgage? Like, why don't you just pay your own? And when you're ready to grow and get into a bigger house, you don't have to sell that home. Put a tenant in there and create that passive income. Rinse and repeat. Get that house and use the equity out of it. There's so much that you can be able to do when becoming a homeowner. But if you need more help as far as the do's and don'ts of what that process looks like of becoming a homeowner, go grab our ebook. No, for real. Go grab our ebook so it can help you on what is the different types of loan options, what is some different programs that you have to come up with your closing costs. You could be able to buy a house with little as $500 down. Like seriously, $500 is $500 down. There's so many programs that's available to you at your fingertip, and so it's just making sure that you know what's available so you can make the best informed decision that impacts you and your family to come. And before we get out of here, just make for sure that you are not inquiring more debt. Don't go buy a new car. Don't be co-signing for nobody, because you don't want to be fumbling all this hard work. And so make for sure you don't co-sign ever on somebody else's house that ain't yours. I don't care how much you were in love, okay? Never co-sign for anybody. But those are some things that you never want to do when you're in the process of purchasing a home. Don't make no large deposits, no large withdrawal. Make for sure every dollar is accounted for. If you need help of purchasing that home, you could do gift letters of someone could be able to give you money. But there's so much more that goes into becoming a homeowner. But grab our ebook so we can help you on making your dreams a reality. And before we get out of here, I just got one question for you. Is that house in your budget?